Welcome to the 3 in 10 podcast. I'm Scott Slayton, partner and chief strategist at Capital Creek Partners. In each episode, I'll give my brief perspective on 3 things we think market participants need to know this week, and we get it all done in 10 minutes or less. For additional resources and analysis, please visit our website at capitalcreek.com. Welcome to the 3 in 10 podcast for Friday, May 1st, 2026. We're recording at 6:30 p.m. Eastern Daylight Time, and here is your starting lineup. Connecting the dots on inflation. Is inflation beginning to accelerate? Key question for markets and for the Fed. Number 2, Exxon. We go through their earnings, we go through financial metrics, and we get into the weeds of a giant turnaround of this very important U.S. company. So on inflation, we received 3 data points this week, 3 dots. And I'll start with a confirmed upturn in ECRI's future inflation gauge, otherwise known as the FIG. This future inflation gauge is predicting a sustained upturn in inflation. And according to ECRI, the cyclical upturn in inflation was in place well before the Iran war. The Iran war has just reinforced what they think is going to be a cyclical upturn in inflation. The March core PCE inflation rate printed in line at 0.3% increase month over month, and a 3.2% increase year over year, well above the Fed's 2% target. Once again, its services, core services, increased 250 bips out of the 320 bips for the month. The great majority of it was in services, but also durables increased by 41 basis points, and non-durables increased by 28 basis points. So now we have the 3 principal elements of PCE inflation: services, durables, and non-durables, all going up together. That's very different than 24 and 25, when durables and non-durables were flat to down. Now they're all going up. Super core inflation, which is core services less housing, was also well above 3% at 3.14%. All of these appear to us to be trending higher. When we print out charts of these and we look at it on the screen, we see nascent uptrends. Interestingly, the April ISM manufacturing prices paid series hit the highest level in 4 years at 84.6. That is the highest print since April of 22, when inflation was raging at almost double digits. So ISM prices paid is considered a leading indicator of inflation, and we think it's interesting that 85% of supply managers are seeing higher prices paid. They're paying higher prices to their suppliers. The Iran war is not going to help this picture. Energy product prices will begin to bleed into everything that we buy, everything from food to clothing to just about everything that we buy will be impacted by this over time. The Fed is on hold for all of 2026 is what we took away from the meeting and the statement. And we felt like the easing bias still embedded in the statement was hollow at best. This is a bank that has moved to complete neutrality, in our opinion. And the big question for the bond market and for all markets is, will inflation accelerate meaningfully above 3% in 2026? And we think there's a very strong possibility that it does. An incoming Fed chair, Kevin Warsh, in our opinion, is walking straight into a very difficult situation on many levels. Now, number 2, on to Exxon. Exxon reported first quarter 2026 earnings of $1.15 per share versus a 96% estimate. So very solid beat there. Revenue also beat in the quarter, printing $85 billion versus $81 billion estimated by the street. Total production was in line, but still impressively up by 8% year over year. That's coming from the Permian basins, from Papua New Guinea, and from Guyana. So that's where the real production growth is coming. Free cash flow missed a little bit to the downside. I think that was a little bit of a lead blanket on the stock. But I wanted to hear what management was saying about the future, and they gave us a lot here. I will quote them several times here. Quote, first quote, increased oil prices are expected if Hormuz remains closed. Well, that seems like a very obvious quote, doesn't it? But prices have not been going up very much. I mean, we hit the highs early in the closure of Hormuz, and for the last 6 weeks, we vacillated around 100, 120 on Brent. But they think that prices will continue to go up if it remains closed. They say there's probably a 2-month lag to get back to normal after the war is over if Hormuz gets reopened entirely. And they also said that SPRs will need refills and that larger buffers will be needed by entire countries. So they think higher prices of oil and products are ahead. Now, refining did fantastically well in the quarter, record utilization of Gulf Coast refineries here in the U.S. Chemicals did fantastically well. They are benefiting from natural gas prices in the U.S. that are just a fraction of everywhere else in the world. And all that Middle East chemical production, a lot of it is shut in now due to the war. So people forget, but Exxon is one of the largest, if not the largest chemical company in the world, buried inside of Exxon, and they're coining money in chemicals and refining. They said something interesting, that the U.S. administration is not contemplating export bans for oil or products. That's great news. And they said it would be very harmful if we did that, not only to the oil industry in the U.S., but to the rest of the world who desperately needs U.S. energy products. And the CEO said a higher risk premium is likely to remain embedded in oil prices for a long while to come. And that makes sense to us, because when you go through a catastrophic event like this, you're going to embed risk premium, because everyone knows that the Gulf is a volatile region now. We've had several wars there recently, and this one shutting in Hormuz for months. And interestingly, this quote I really like: the market has not fully discounted extremely low inventories for oil and products. That to me is code for higher prices are going to be sustained, and probably even higher prices than we see today are likely to be ahead. So now just a thought on Exxon CEO Darren Woods. I think his career is very unusual in that he came very close to being fired back in 2019 when the company had performed very poorly under his watch for years. An investor named Jeffrey Ubben and Christopher James from Engine One came in and basically helped change the board and encouraged Mr. Woods to do several things to increase shareholder value. And I think they have succeeded, probably beyond their wildest dreams. And we have to give some credit to Darren Woods for this, because he opened his eyes and he wanted to stay in the job. And he knew that he had to increase performance to be able to stay in the job. And he did so. On every metric, returns have improved. ROEs have gone from about 8% during the first half of Darren Woods' career to 18 to 20% over the last 5 years. ROIC went from a paltry 3%, not even coming close to earning the weighted average cost of capital, to now 10 to 11% over the last 5 years. Free cash flow was running, 5 to 10 billion in the late teens, 2020, and has expanded to anywhere from 25 to 35 billion over the last 5 years. Some of this, of course, has been a result of better cyclical tailwinds for the oil industry, for sure. But I looked over many years and on many metrics, and Mr. Woods, in my opinion, is simply running a much tighter ship, and he is managing Exxon better. He probably grew in the job. He got some guidance from people like Doug Terreson, the great energy analyst Doug Terreson, who designed the pledge, which was to get these companies to be relevant again. They had to return cash to shareholders. And Mr. Woods bought into this, and he has returned a ton of cash to shareholders through dividends, through buybacks, and through a much better performing stock. So the stock has recognized all these improvements and has gone from $55 in 2019 to $175 a few weeks ago in only 5 years. So hats off to Darren Woods, a CEO who saw the light and turned a giant company into a shareholder value creation machine. Do the work, endure the fog of war, and have investment prudence.
The information in this podcast is educational and general in nature and does not take into consideration your personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategy or investment may be suitable for you, consult the appropriate qualified professional before making any final decision.